There's been a lot of focus on the iron ore price in recent times, with prices falling below $50 a tonne, down more than 50% over the course of the year and almost 30% just this year alone. First chart just having a look at here is the shows iron ore prices in red year on year on the left hand scale, so you can see they're down more than 50% on a year ago. The blue line shows Chinese steel production, which has now gone into negative territory for the past few months, so only just, but nevertheless easing back, and that's been a contributor, of course, as has the ongoing increase in supply of iron ore. What does this mean? I guess very importantly for Australia, what does it mean for growth and national income going forward? Because if we look at some of the historical relationships here, and I'm just looking at the chart here shows real gross domestic income growth, and that will reflect the terms of trade, and you can see that quite a close relationship here. Real GDI, 3-year annualized over the going back to the 1950s, that's the blue line. You can see there it's now growing over the past 3 years at a rate of around about 0.5%. In terms of trade has been declining, red line right hand scale at around about 8% per annum. So you can see that the two have been closely tied, and the blue line real gross domestic income at recessionary type levels. The situation probably looks even more dire if we consider what is happening to income per capita. So this chart now we're looking at real national net national disposable income per capita. As you can see here that that's now actually contracting, blue line left hand scale, by about 1% per annum over the last 3 years, and the terms of trade has been declining, as we said earlier on, by about 8% per annum over that same period. What about going forward? Well, over the past 3 months, as we mentioned, the iron ore price has fallen quite sharply. So if you look at a 3-month moving average percent change on the previous 3 months, you can see blue line left-hand scale that iron ore is down about 20%. Now, what this suggests then is that the terms of trade, we should see a further decline in the terms of trade, possibly as much as 3 to 5% over the coming quarters, on top of what's already occurred. So in order to have a look at what this might mean for incomes, it's useful to go back and have a look at the relationship between real GDP and real GDI, or gross domestic income. In this chart here, we're looking at annual growth rates in those two series. The pink is the growth in real gross domestic income, and that will incorporate the terms of trade impact. So during the period from the early 2000s through to 2000, well, essentially through to 2011, with the GFC interrupting that sequence, you can see how GDI exceeded the growth rate for GDP, on average by about 2% over that whole period. Obviously, since 2011, the pink line, GDI, is now growing at a slower rate compared to gross domestic product. Now, looking at those just in dollar terms, and there's the two charts. So we're now looking at the pink line here, or start with the blue line, is real GDP in dollar terms. This is quarterly, so 285 billion, running at that rate back in 2003, growing to about 395 billion. So that's an increase of 110 billion, or 440 per annum. Whereas in the case of real gross domestic income, grew from 255 to about 385, 130. So essentially the difference between the two over that period of time is about $80 billion. So in terms of trade impact, we might assume is around about 80, a little bit more. But it's actually hit a peak a little bit earlier. So if we now have a look at first I'll have a look at the terms of trade. So we know that in the 36 months leading to September 2011, we had basically a 95% increase in the terms of trade from the trough. Let's just select the trough here, and there it is there. So an increase of 95% over that period. Real GDP We can see here from the end of 2002 grew by about 29%, and real gross domestic income grew by about 48%. As a ratio, GDI relative to GDP, it grew, let's say, by about 15%. So one could estimate that the terms of trade added on average over that 36-month period or 9 years about 15%. Let's call it around about 1.5 to maybe 1.75% per annum added to growth. Now, what if this now goes into reverse, as we were just alluding to? The terms of trade, as we can see here now, since September 11 is down 26% over a little bit over 3 years. Real gross domestic income has gone sideways. GDP has continued to go up, but the ratio of the two has actually fallen from 0.0 September 11 by about 6%. So that's 2% per annum detracted from the declining terms of trade. 2% underperformance, I suppose, of GDI relative to GDP. So going forward, if we assume, and this is a pessimistic scenario, if we assume that the terms of trade and iron ore prices go back to their long-term trend, i.e. back to where they were, for example, back in 2002, that would entail a further 6% decline in this ratio, which would amount to an extra 1.5 to 2% per annum over the next 3 to 4 years, which would mean that incomes would continue to grow, or gross domestic income would be growing at roughly 1.5 to 2% below GDP growth, which, if we estimate that to be around about 2.5%, would suggest that gross domestic income would continue to grow at the very slow rates of 1% at best, possibly even lower.